In today's episode, I get to share some exciting news with you. For the first time in over 24 years, we have a proposed change to the pattern day trader rule, also known as the PDT rule. And if this change takes effect, it's going to completely change the game when it comes to day trading the US equities market. So as many of you may know, and you may not, but if you don't know, I'll share it with you now. During the late 1990s, we had what was called the dot-com bubble. Now, the late 1990s, we were experiencing a surge of day trading in the US markets because online trading was a new thing. And so you didn't have to be a broker working on Wall Street to trade the markets. Anyone from their home with an internet connection could day trade. And so people were day trading using a lot of risk, and a lot of people blew up their accounts. So regulators stepped in and they wanted to do two things. Number one, protect individual retail traders and investors, people with a small amount of money, from losing their shirts. And number two, they wanted to protect the brokers from having customers blow up their accounts, which could put the broker and the bank, the clearing firm behind it, at really a systemic risk if you have all of these people blowing up their accounts at the same time. So to address these two concerns, on February 27, 2001, they enacted the pattern day trader rule. What did the pattern day trader rule say? It said that if you're going to day trade 4 or more times in a 5-day period, which would be anyone who's a day trader, you need a minimum account balance of $25,000. Now, this only applied to margin accounts. So when we're trading, you have two different types of accounts that you can open. You've got a margin account, and then you have a cash account. Now, if you fund a cash account today, and let's just say you fund it with $5,000. So it's a $5,000 cash account. And you want to buy, let's say, 5,000 shares of a stock at $1. So 5,000 times $1 a share, you're going to put in $5,000 into that position. You could buy it. You could sell it at, let's just say, $1.10. You'd be up $500. So $5,500 comes back to you. But guess what? You can't trade with that money again until that trade settles. Now, in 2001, trades didn't settle overnight the way they do today. It took 3 days. So that means if you traded on Monday, you couldn't trade with that money again on Tuesday. You couldn't trade with it Wednesday. You couldn't trade with it until Thursday. So effectively, if you had a cash account, you could not day trade, certainly in any meaningful way. Now, today, it's a little bit different because now we have T1 settlement, which means you could trade with that $5,000 and tomorrow you could trade with it again. So in this scenario with a $5,000 account, you could take one trade, with $5,000, or you could take 10 trades with 500, or you could take 100 trades with $50. Doesn't matter how you slice it. You could trade $5,000 worth of stock in one day, and then you're cut off for the rest of the day. But with a margin account, let's say you've got $25,000 in it. With a $25,000 margin account, you can do an unlimited number of day trades. So you could buy and sell 1,000,000 times in one day if you wanted to. Now, back in 2001, you would have been paying a commission on every trade of $9.99. So you wouldn't take even 100 trades in one day because your commissions would be so high. But wait, that's not the same anymore, right? Commission-free trading. So today, you could take a lot of trades if you wanted to, and it's totally free. So here's something that's kind of interesting. Back in the dot-com bubble, when you had all these brokers that had clients blowing up accounts, the regulators came in and they tightened things down. They said, we're going to enforce this pattern day trader rule. It's going to protect the retail traders and it's going to protect the brokers from customers blowing up accounts. And so anyone who had a small account had to do one of two things. Either borrow money from someone to get their account above $25,000 so they could keep day trading. And a lot of people did that. They took out loans. And who benefits from that? The broker, because now they've got more money on their balance sheet, right? They've got more capital, more client assets that's under their umbrella. So that was a good thing for them. Now, were there some people that couldn't afford to do that and ended up getting kind of knocked out of the game? Certainly. But in the short term, it was good for the brokers. Now, fast forward 24 years later. Okay, so today, commission-free trading is all the rage. You don't make money as a broker by someone just, getting a $5 or $10 commission. You make money the more shares that they trade. So now this pattern day trader rule is kind of a problem because it's slowing people down from trading as much as the brokers might like in order for the brokers to make more money. So naturally, what would be a good solution to this would be reducing the pattern day trader rule from what is currently $25,000 to, I don't know, say zero. Well, that proposed rule change is not happening, but here's what they're suggesting. They're suggesting changing the $25,000 minimum to $2,000, to $2,000. So now, all of a sudden, if you put in $2,000 into an account, you could day trade as much as you want. Now, I think at the very beginning of this episode, I mentioned that with these margin accounts, you get a couple things. With a margin account, and let's just go back to $25,000, you have $25,000 US dollars in a margin account. You not only have unlimited amount of day trading you can do, but the brokers give you what's called leverage. And they give you 4-to-1, which means the $25,000 account actually has $100,000 in buying power. Now, this again, there's an incentive for the broker to give you this buying power. The more you trade and the bigger the positions that you're trading, the more volume they're doing, the more money they make because they get a kickback on volume. Then that's not new. That's always been the case. So they want you to trade with bigger size. They want you to buy and sell as much as possible. So this proposed rule change doesn't do anything to change margin. So in this new scenario, with a $2,000 account and presumably still 4 times leverage, you're now going to have $8,000 in buying power. And this presents some risk because here's the problem. Let's say you see a stock that's squeezing up and you decide, well, let's just say, let's look at some trades from today. I'll pull up my charts in just a second. We'll look at a couple trades from today. Let's say you saw a stock that was squeezing up here. I've got one for you, HTOO. So this is a stock that I traded earlier today. And there's no question this stock was very volatile. This stock in really one candle went from about $4 a share to 14. Okay, that's a huge move. Let's say you're a novice trader. You're at the very beginning of your career. You don't really know what you're doing yet. You see this stock squeezing up and you say, you know what? I'm going to go ahead and buy it right here. Not a good idea, but let's just say you're a beginner. You did it. Mistakes happen. Well, right here is $14 a share. So let's just say for the sake of argument that you jumped into that. You've got an $8,000 account. So let's just say you bought 500 shares times $14 a share, $7,000. Okay. So you got $7,000 in the position. And then a moment later, this stock, it peaks up here at 14, and then it drops all the way down to under $9 a share. $9 a share. Holy smokes. So you're in at 14, it drops to 9. Well, wait a second. Let's say you sell it at $9. So 500 times 9 equals 4,500. Wait a second. You're minus $2,500 on this trade. Your account just went into the negative. It's not just that your account has gone to zero. It's actually minus $500. And this is the very real risk with trading using leverage. So here's what I proposed. Now, no one's listening to me, evidently, because what I proposed has not been submitted to regulators as a possible change. What I proposed was, can we separate leverage from settlement margin? Can we make it so you could fund an account with $2,000 and you get instant settlement? So essentially, you are borrowing money from the bank because the trade still has to take a full day to clear, but the bank knows you're good for it. These trades always settle. So they essentially extend you the money to keep trading through the duration of the day, knowing that all of those trades will settle. So now with a $2,000 account and unlimited and settlement margin, you could take an unlimited number of trades, but you're not using leverage. So what I hope will happen is that FINRA and regulators decide to accept this proposed rule change to reduce the pattern day trader rule from $25,000 to $2,000. But they say that in order to day trade using leverage, you still need a larger account. Now, ultimately, the brokers could certainly do that. Charles Schwab, E-Trade, Webull, they could say, we'll let you day trade an unlimited amount of times as long as you've got $2,000, but we won't extend you leverage until you've got a $5,000 account or a $10,000 account. It could be the discretion of the broker to make that rule. And that would probably be just as well. It would be okay if that was the way it ends up happening. I suspect that most retail trading brokers would probably choose a line there, because if you have a trade like this that so quickly goes against you, you would be in the red before the broker could even step in and intervene. Because when you're actively trading, the brokers can see all the accounts. And so they have these algorithms where if an account is approaching a max loss or going into the negative, they can auto liquidate. But in a really fast moving market, there may not be time. So that's not as big of a concern if you've got, let's say a $25,000 account. You've got a $25,000 account, you've got a really big cushion before you're going into the negative. But if you've got only $2,000, well, there's not a very big cushion. So the proposed rule change is to drop the PDT rule from 25,000 to 2,000, and that's it. That's the rule change. But I think that most likely brokers will step in, and if this rule change takes effect, they will say that in order to have 4 times leverage, you need a new, minimum. And maybe that minimum will be different from broker to broker. We know brokers right now in the Bahamas that let you day trade with 4 times leverage with even as little as $500. And they're certainly taking risk. They're going to have people that blow up accounts, but they must feel that they make enough money to justify the risk. So where will Charles Schwab, Webull, E-Trade, and the others draw the line? Maybe it'll be at $5,000, maybe it'll be at 10, maybe they'll leave it at 25. I suspect if they leave it at 25 for leverage, there wouldn't really be a problem as long as you can have settlement margin with as little as 2,000. And there's really no reason why you shouldn't. So best case scenario for this proposed rule change is that it gets reviewed in the fall, gets approved, and then goes to the SEC for them to decide whether or not it's going to be implemented. If it does get implemented, it's still going to take broker-dealers some time to really roll it out. So best case scenario, we're probably 8 months to a year away from seeing this come into production, where you could fund an account with $2,000 and day trade as much as you want. But here's where I think this is going to be a game changer. If all of a sudden the barrier to entry is that much lower, there's going to be a lot more people that come into the market. And so what that's going to mean is a lot more money for broker dealers, because they make money on every trade you take. So they're going to be encouraging, advertising, promoting the market to all these potential customers. And what we're likely going to see is increased volume in the market. Increased volume, most likely among retail traders, is also going to increase volatility among lower priced stocks. So that's what I would expect if this rule change goes into effect. So in order to prepare for that, I would tell you, if you're a new trader right now, certainly practice in the simulator. If you haven't been actively trading, spend some time practicing, because we may see a year from now a big surge of momentum in the markets, and you want to be in a place where you're prepared for it. Because if you haven't traded at all, and then all of a sudden you get this surge of momentum, there's a temptation to jump in, but you have not yet paid your dues. You haven't trained, you haven't practiced, you haven't proven you can maintain the metrics that justify trading even with real money. So pay your dues now and get ready, because if this rule change takes effect, I think it's going to have a big impact on liquidity and volatility in the overall market.